Hey guys, let's talk about investing really quickly. So, what I want to talk about specifically is my philosophy around investing. Now, my philosophy around investing is pretty simple. It's just that investing isn't about getting rich, it's a way to maintain wealth. It's not a way to, you can grow your wealth, but more or less maintain your wealth, right? Uh, I, I'm happy to hit a home run, right? I would love to buy Walmart in the 70s, Coca Cola in the late 80s, whatever, right? And hit a massive home run. Or buy Amazon in 2004 or something like that. Uh, like, I would love to hit a massive home run. And it's okay if you do. Um, and it's okay to try to hit those home runs every so often, but and to try to do so in a meaningful way. Um, but the thing that I want to stress is that when you're investing, the number one goal that you should have is to not lose, which sounds funny, but that's because of my philosophy around investing. And that philosophy says that you should not try to gain a ton of money off of investing. You should really just be focused on preserving what you have, right? And sort of my thought process here is that if you have three things, right, that could happen to you in investing, you can lose, you can go nowhere, or you can win, right? And if there's sort of even probability between those, right, 33%, 33%, 33%, what's going to happen is that if you play not to lose, all of a sudden you're only left with two options, right? And those two options are you don't do anything or you win. And that 33% that's allocated to losing gets allocated into those. And so you have a much higher chance, right? You have a 50-50 chance of winning. But it doesn't quite work that way with investing. Over the long term, the stock market has shown that it's happy to continue growing and to continue winning at a rate of about 10% per year. So if you just play not to lose, you already have this huge advantage built into the market that says you are going to win. And you just increase those odds proportionally to winning or to just staying in the same place. And so if you're playing not to lose, you will win, right? That's sort of my philosophy. And so that's what I try to do. And that's what I try to teach is I try to teach you how not to lose in the stock market. Because if you don't lose, you are definitely going to win. That's just the way that the market works. It's very rare that you don't lose and you don't win, right? You sort of stay even. So all that I'm saying is, look, if all that you do is you win at a very consistent pace and you don't have any major setbacks, it's going to work really, really good for you. I'll give you an example. Last year, mid 2021, height of the market, everything was going bananas crazy, and I was looking around and I'm going, look, inflation is going up. You can probably see on the card here or over here a link to my video about inflation that I put out a year ago. For a year, it's been the only it's been the only video on my channel. And I was looking around, I'm going, okay, inflation's about to go bananas. The market is insanely high at the moment. There's a ton of people who are just overly exuberant about stocks and the stock market in general and all that sort of stuff. Let's go looking for something that's going to work. So I'm looking around and I go, okay, what's going to work in a highly inflationary environment? A company that doesn't require a lot of capital expenditure. That is one of the things that you will want in a highly inflationary environment. Traditionally, those have been software companies, things like Google, Facebook, Amazon. Those things, very, very low capital maintenance costs. Unfortunately, those were the things that were very, very highly overvalued in the market at the time. So I started looking for other things because I didn't want to lose, right? And so one of the next category down on the list is companies that have just completed massive capital expenditures. They're going to do well in an inflationary environment because everything's going to inflate around them and they've already paid for it with deflated dollars, right? And Verizon sort of checked that box, right? With the 5G rollout that they did, it was they had all of this money that they paid out already for their capital expenditures. As a matter of fact, they probably paid out 10 years worth of capital expenditures in 2020 and 2021. I'm looking at that, I go, okay, they just did a lot of CapEx and it's been very deflated, right? With deflated dollars that are set to explode, right? They're set to inflate a ton. So I go, okay, that ticks the box of one of the things that I'm looking for in an inflationary market. The second thing that I was looking for that I saw in Verizon was that they funded it with debt, right? And a lot of people were looking at Verizon and still look at Verizon and they go, oh, this company, way, way too much debt, zombie company. And what I was seeing was, okay, yeah, it's a lot of debt, but they've got a lot of cash flow that's coming in too, and very consistent cash flow. Like, when's the last time you didn't pay your cell phone bill, right? And so I was looking at that and I go, okay, they could probably fund this debt. But more importantly, how is this debt structured? And it turned out that this debt was structured with very low interest debt, very low interest fixed rate debt. They had, I think it was like a 3.2% weighted average interest rate on their debt, which was great, and it was funded through the bond market. And so I was looking at that and I go, ooh, if inflation ticks up, what's going to happen to the bond market? Well, yields are going to go up, which means bond prices are going to fall, which means that Verizon, with their massive cash flow, is going to be able to buy back that debt at really, really cheap debt. So they did all their CapEx with deflated dollars, and they're going to be able to pay down their debt with inflated dollars. And not only are they going to be able to pay down their debt with inflated dollars, they're probably going to be able to pay it off at 75 cents to the dollar. And I was sitting there and I'm going, I think there's value here. And then looking at the company, I was like, okay, it's got a single digit PE. They did all of their CapEx. They've got this debt thing where they're going to be pulling money from the bond market over to the equity investors. I'm sitting here going, yeah, I like the way this is set up. Do my valuation, it was saying somewhere between $50 and $55. It was a year ago. I don't remember. I ended up paying around $53 a share for Verizon. And I go, okay, let's see how this plays out for the next year. Fast forward a year to today. My position's only down like 3%. Well, the general market is down 20%. I think my thesis worked out pretty okay. I think that it did exactly what I thought it was going to do. So, been very happy with it. But that's the point, right? Is that I was looking at this really high market and I'm like, okay, where can I put some money? Or that's probably not going to do too bad. And Verizon was the place, right? And it's done really, really well. I haven't really participated in the market going down, and I'm getting a 5% yield on the dividend, and I think that that's just going to continue. Probably going to see 10 to 13% once they start paying down their debt. Returns in terms of asset appreciation. So yeah, I think that's the way to think about investing, is how not to lose, and you'll probably win. All right, peace out, guys. Talk to you later.